Hey everybody, welcome to the Dollar Vigilante. You might not know from my walk and talks that the Dollar Vigilante is actually a financial newsletter. I talk about a lot of other stuff a lot of time while walking my dogs, but that's actually what the Dollar Vigilante is, if you didn't know. We've actually been around since 2010. It's 16 years now with Ed Bugos as my partner. When we first started, I don't remember the exact numbers, but I think gold was probably around 700 or less. Silver was like probably $5 or $10. Bitcoin didn't even exist. Well, it kind of did. We started in 2010, so it just started like a couple months before. I didn't even know about it till 2011, but we recommended it at $3. And with everything going on, like I've kind of said this year, there's going to be a lot of financial stuff this year. So this is what the Dollar Vigilante is all about. This is what our newsletter is all about. We've had some incredible calls in the past. And I wanted to have Ed Bugos on. I'll probably try to have him on fairly regularly if I can, because there's going to be a lot of stuff happening this year. You can kind of tell, and a lot of kind of shocking stuff, even to myself. For example, the stock markets in the U.S. are basically at all-time highs, just keep going up, even though we're in this supposed kind of war thing, which actually Trump just said yesterday that he expected that when they did this attack on Iran, that the stock markets would fall 25%. That actually wasn't the case. It dropped a couple percent, but now it's up to all-time highs again. He also said oil could have gone to $200 to $300, but it's as of right now, it's around $100 still. So there's a lot of things that we could talk to Ed about on all that stuff, where he sees everything going. Of course, we're pretty heavily into gold, silver. Actually, the last time I had Ed on we were talking almost completely on gold and silver because they had just broken out to massive new highs. Gold had broken out to about 5,500, I think. Silver was like $120 or something. And in the first few minutes of that interview, Ed basically said, a lot of people probably aren't going to like this, but when these things happen, there's usually followed by a massive drop. And I think it was the next day or the day of our interview was released, silver dropped like 30 or 40% that day or something. So Ed nailed that. So you might want to pay attention to this one. Ed, how you doing?
Hey, Jeffrey. I'm doing good, doing well, in proper English terms.
Good. Where should we start? You want to start with stock market?
Sure, we could start with the stock market, or on going on your theme about that if people don't know what we have is actually a financial newsletter. It's the theme of our newsletter is the dollar collapse theme, right? And as you know, the dollar, the foreign exchange rate of the dollar, versus other fiat garbage has been, rising for 15 or 17 years. So it's been in a bull market, and so a lot of people might wonder, well, what the hell are they talking about? They've been talking about this dollar collapse for forever. And I just want, I think people need to understand that when we talk about the dollar collapse, we're not just talking about the foreign exchange rate versus other fiat currencies. We're talking about its collapse versus everyday things, versus assets. The fact that they destroy the dollar in order to manipulate, economic metrics. We look at the investment world through the lens of a system that manipulates economies by destroying currency values. And so, when you hear the dollar collapse theme, the bottom line is the dollar has been collapsing. It's been collapsing for ever since the Fed went off the gold standard, right? Almost 100 years ago, I think. Right? What is that? 1933. It's almost 100 years, right? 93 years, right? Since
You
we
talking
went off
about
the
when the
gold
Fed
standard.
was founded in 1913? Or are you
No, no,
talking about
no.
when they went off the gold standard, 1933? Yeah, so that's
Yeah.
close to 100 years now. Of course, the
Yeah.
dollar's kind of collapsed by about, I think, 98 point something percent at this point.
Yeah.
Um,
Once you get
and
past 98%, it's like 98.9,
yeah,
98.99.
yeah. It actually just occurred to me today. I didn't fully think about it in these terms until just today. I was just thinking, because I was thinking we started the Dollar Vigilante in 2010, And we actually haven't had a massive market crash since the founding of our newsletter. We've been in a basically a bull market since 2008. It's 18 years now. It's incredible.
That's right. That's right. It's the it's the longest bull market stretch now, I think, pretty much in history. I think we saw, from 1933's low, you could probably say there was, well, I think that bull market didn't start until after the war ended anyway. So you could say that 1945 to 1965 might have been a longer stretch, right? The 80s and the 90s, that was almost 20 years. And I mean, time flies, doesn't it? I mean, it doesn't seem like it's been 20 years as far as I'm concerned. But yeah, no, this has been the longest, one of the longest stretches in bull market history, and definitely one of the most expensive bull markets. Probably only second to the one that we had in at the end of the last century, right? I've seen this graph before. I'm not sure. Yeah, so if you look at the PE ratio there in Shiller terms, you see that the only more expensive market in the history of the S&P, going back 100. Well, the S&P index wasn't calculated before 1960, but retro on this chart, the most expensive market in history. So that's one difference about this market, and there's there's good and bad in this market. One of the reasons that that the market is doing what it's doing, you could say, is because between 2008, when like you say, there's only been about 20% corrections, 25% corrections since 2008, 2010. And from 2008, you know how they reacted? They opened the money spigots, QE1, QE2, QE3. By the time QE3 came out, the Fed was basically printing up $1 trillion a year, like $100 billion a month, just buying treasuries, and mainly longer term treasuries too, not just the short term treasuries that historically the Fed used to buy. So they were trying to manipulate longer term interest rates in doing that too, and try to get that 10-year yield down to zero, as well as the short term yield, right? Because previously, before 2008, in a Greenspan, they got the yield down to 1%, but that was the short term yield. They couldn't get the 10-year yield below 5%, right? And so the 2008 crisis, lo and behold, gave the Fed the opportunity to expand its power to be able to buy longer term treasuries so they could manipulate longer term yields as well. Okay, so with the advent of the QE, right? So $1 trillion a year from 2013 or 2012 through to 2022. Okay, and interest rates were at zero. Even the long-term rate were down close to 1%, I believe, or maybe even less for a little while, especially in 2020. And then what happened in 2020? I think they printed up $6 or $7 trillion. So what I'm trying to say is that this stock market, although it's been founded in probably the most expansive money and debt inflation in history, which should send red flags to everybody, which it does to us. There is an underlying component that speaks to the resilience of the U.S. economy that I think a lot of us underestimated, including me, of course. And you could say that I didn't take into account the amount of money that big tech has been able to make. It's been able to throughout that 10-year period, the last 10-year period, it's been able to increase profit margins, double from like 7 or 8% net income margins to 13 or 14% today. If you look at the market shares, the share of market cap that that say energy companies take take up in the overall S&P market capitalization, right? So if you look at the overall S&P market cap, the share of that belongs to energy companies, you can see has been in this chart. You can see it's been falling over 10 years, whereas the share of market cap that belongs to the AI companies has been increasing. So like the energy companies are like below 10% market cap of the S&P, whereas the AI companies have increased their share from something like 20% to 36%. Okay, so that's important because when we say like, when we say earnings, and here's a chart of what earnings look like. So you can see. So like you say, well, what's making the market go to new highs? And like a lot of people think, correct? Probably over the last year and a half, you're not incorrect in saying the market has relief rallied itself to new highs. Do you know what I mean by that? So you remember the Liberation Day reciprocal tariffs that Trump put out last February? It dropped the market 20-25%, and then we went off to new highs. And why? Because of what everybody calls the taco trade, where Trump says something really crazy and then he pulls back. Okay, so and you think to yourself, but that does that justify the market going to new highs? And we're seeing that now too, right? Every time he says he's going to bomb the Iranian civilization out of existence, and then he pulls back and says, well, then maybe not. And then what happens is the market goes to new highs, right? So people will look at this and go, that's so weird. I mean, it's like every time the market size a bit of relief, it goes off to new highs. How do we make sense of that? But the bottom line is, as I showed you in the graph there, earnings. Okay? These earnings have been very strong, but they're concentrated in the AI sector. Outside of the AI sector, if you look at, for example, this graph here, you'll see the difference between the earnings growth over the last 10 years for AI stocks and the earnings growth for the rest of the market. So you can see that the rest of the market has lagged quite a bit. And so with AI and big tech taking up an increasing market share of market cap, they're also taking up, influencing these earnings, right? And I haven't even mentioned buybacks. Buybacks also tend to extend the per share earnings value of the S&P units. Okay, so without the buyback influence, the difference wouldn't be so great. But overall, you can see that the AI stocks have not just outperformed in the market, but that's where most of the earnings gains are in the market, and it's in this sector has grown to like almost 40% of total market capitalization, right? So, and you can see in this graph here that that the overall breadth of the market has been declining for over a year, right? So you've got fewer and fewer stocks that are making all of the money, and then and you say, well, and then you got the bears that'll say, and I'm a bear, and you got the bears and they'll say, well, and they're right, the AI companies have been capitalizing a lot of their capex in investment, and all the rest of the big tech companies have been making money off of this massive investment in build out of data centers by what has become to be called hyperscalers, the Microsofts, the Amazons, the companies that are investing in all these data centers to keep to increase the storage capacity for AI to do its business. Okay, now the critics will say, okay, well, look, these guys are way ahead of the consumer. The consumer is not spending that much on AI yet, and so on. So that's correct. It's also correct that the life when they're depreciating these capital investments, right? They're inflating earnings because they're estimating a life of capital. They're estimating a cycle, an investment cycle in capex that's longer than it actually is. Okay, so in doing that, they're depreciating less than they should, so they're inflating their current earnings, and that'll come home to roost in the future. Okay, so the critics are right about that. They're right about the fact that there's bottlenecks that have come up, in certain types of AI chips, in certain types of memory storage, right? And there's so those criticisms are all correct about the AI bubble, and whether it's a bubble or not, we don't really know, because they could be right. They could be like, all right, see, we were ahead of the consumer, but look, the consumer figured out how to use it, and now we're back at the limits of our storage capacity. So, our investment proved correct, but they're way ahead of the market, and we don't know that they're going to be correct, but there are indicators that they might not be correct. But the bottom line is that I think the bears, us, have underestimated how much money the big tech can make without increasing labor costs. How much money, where they can get the creativity in terms of ideas for additional revenues from existing business models in the digital world. You can increase your revenues in lots of different ways. We see that from our perspective too, in running a newsletter. There's lots of ways to increase revenues where we don't have to hire somebody else, right? So I think on the one hand, we've underestimated the capitalism of the big tech area, and not that it's pure capitalism, not that it's not infiltrated by all sorts of public-private partnerships and cronyism, but generally, I think we've underestimated how much money these guys could make. But at the same time, they're the only game in town, right? And we should mention that we are short this bubble, and we've been trying to short it for a few years here, but just in case some of our haters and critics come out and say, well, you guys have been wrong on that for a few years. Yes and no. We've been hit and miss on that because we've made money on some of the hits, but mainly the point I want to make is that 80% of our ideas, or our investment holdings, or our recommendations, if you want to call them that, belong to assets that have been outperforming the Dow, outperforming the S&P, and even the tech stocks as a group for the last 10 years, right? So, crypto, gold, the gold miners, the 80% of our portfolio, 60% today, because I've been raising a lot of cash in this environment. But over the last 10 years, 80% of our portfolio has been doing just great, right? So we're off a little bit on the short side of things, but But so let me get, I know I've been chatting here a little bit too much, but all I wanted to point out is that there are real factors behind the new highs in the stock market. And the bottom line is earnings, right? Everything else, the macro environment, the geopolitical environment, the demographics of the stock market, those are all negative, and they're so negative that it's hard to look at the positive within. But then when you do look at the positive within, at this point, you realize, well, the market cap of these tech stocks it's started to dominate the averages, and so it's very concentrated in that one sector. It's long in the tooth in that one sector, and there's we could be approaching a time when some disappointments in those earnings start to show up going forward. So I don't know
Yeah,
if that.
it's definitely interesting times. For me, it's very interesting because the things that led me to starting the Dollar Vigilante with you was when my tech company collapsed in 2001, right on 9/11, which was also the day of the Shemitah. And that's when I started looking into how central banking worked, and that led me to Austrian economics, and that led me to meeting you and things like that. And this really seems very similar to those times. And of course, that was a major market peak in 2001. In fact, when we talk about the stock markets have been going up since the founding of our newsletter, or even before that. They actually, in gold terms, they're down dramatically. If you look at the Dow Jones performance versus gold, it was at a peak of 1,400 grams of gold per the Dow Jones in 2001, and it's been going down pretty much ever since. It hit a bottom in 2011. It's close to that bottom now again in 2026. So in real gold terms, actually, the stock markets have performed very poorly. And
No, that's right.
that's actually when you got into gold. And for people who don't know, you were actually working at a brokerage in Vancouver, and everyone was all going crazy about getting into tech stocks back then. Like I said, it's all so deja vu for me. And you were telling everyone to sell near the tops and to buy gold at $200 an ounce. And if people had done that at that time, they'd be wildly outperforming the stock market.
Yeah, and I think a lot of people forget that at that time, when the Nasdaq was at its peak in 2000, that it took 14 years before before any investor who bought that top broke even. Right. So for the last 10 years, the Nasdaq has been doing great, but it still hasn't been outperforming our gold miners. Right. Not in terms of earnings. If you look at this graph here on gold miner earnings compared to Nasdaq 100 earnings, right, over the last 10 years. They've basically been mirroring each other. The gold miners have made more money than the Dow stocks, right? They made more money than most sectors over this last 10 years. And they're getting some of what they deserve now. Like some of the better miners are getting a 20 to 25 PE ratio. Most of them between 10 or 15 though. So they're not getting the average market PE ratio of 25 to 28 for the S&P and the Nasdaq stocks. So they're not getting the same respect that the Nasdaq stocks have been getting, even though they've been making as much money, if not more, actually, than the Nasdaq as a sector as a whole. You can see that here in this graph. But so yeah, we've been. I think you could say that we've invested in two of the top three investment themes of the century so far, and we got one wrong, the one on AI. But in any case, the other ones that we've got right have more than compensated for what we've got wrong. So, I'm happy with that, but I'm not happy with I'm not happy with being early on our short on the stock market. Not happy about. I'm not. I have to admit, I'm not happy about underestimating how much money these tech stocks can make, even though the comments I've cited, the qualifications I've cited about all that so far.
Yeah, it's a very interesting time with AI. We could see AI actually wiping out most people's jobs in the next few years. So this is going to get crazy. What's your take on
Well, and
things like
creating new ones though, Jeff. Creating new
yeah, of
ones.
course, that's obviously possible, but it is a massive, massive paradigm shift. Absolutely, like I don't think we've never seen anything like this. It's going to be totally insane. We're going to see so much changes in the next few years. Um, What's your take on the oil market? I've been buying leveraged oil longs a few times along the since the war started. First time was around $84. I sold some at 120, but didn't sell all of it, unfortunately. And then it went all the way back down to like 90 or even the 80s, I think. Then I bought more again, and it went up to 110. I sold some, but not all again. Now it's as we're doing this video, it's currently around 100. Trump just put out another peace sort of a thing. What's your take on that market?
Uh, I think we have to remember it came from $60 about 4 months ago, right? So we're up at, we're almost double on the oil price compared to where it was 4 or 5 months ago or whatever it was. And so you have to ask yourself what has changed in this period. And the main factor that's changed is the 15 to 20% of oil supplies that have been taken off the market. But the impact of that has been very slow on the real side because it takes a month and a half or so for the transportation of the oil from source to the market. But the market has been using inventories to has been depleting its inventories, right? So while it's been depleting its inventories, the supply shock has not been fully felt yet, right? So a lot of the reason that the oil price is up, it's not because of the reality of the supply shock, but because of the expectations of the market, the speculators, lifting the price in the paper markets, looking forward in terms of where they think the supply shock will eventually hit, will eventually move prices. And you have to and remember, markets are very resilient. Entrepreneurs are very creative, and above the $90 level, there's lots of different. You're making an extra 50% markup. So it's like, well, I'm sure there's lots of people thinking of different ways to get oil to the market at a higher cost because they'll still be making the same margin, right? So a lot of that is has been mobilized. Production has been expanded where it can be expanded. There's a bottleneck in terms of refining capacity. So you take out refiners, that'll affect prices, real prices going forward. But I think that the oil bulls probably see things happening as usual. Same thing happened with gold and silver, when they were going parabolic, these guys all believe that we're going to have a reset overnight. And the same thing happens with oil. You see what's happening and you see it so clearly, but the time over which it happens in our minds shortens very quickly, whereas in reality it could still take months before the acute levels of the supply shock start to really show up in the price, right? So right now the buyers and sellers are arguing over what price it should go to if 20% of the market was withdrawn 20% of the supply was withdrawn, which it hasn't yet, right? As I said, the refiners have been working off their inventories. The governments have been selling their strategic reserves into the markets to keep prices down. And Trump has been doing his thing with his taco trade, oh, we're going to go in. No, we're not going to. We're going to, no, we're not, that kind of crap. And so the market's in this state of, well, consolidation. It's consolidating its prior gains, okay? But the pressure is generally higher. Um, what could upend it, the oil trade, is de-escalation, right? So if you've got a case for why all of a sudden all of the war, the march to war that we've seen for the last 2 or 3 years is going to stop and reverse, if you got an argument for that, then you might want to be short oil. But if you think that things are just going to continue to escalate, as time goes on here in the next month or two, as the supplies at the margin get soaked up, then the supply shock will be increasingly felt in the market, and then we'll get another move up. But in between then and now, there's this problem of of an overvalued asset market that has no support from the Fed, the stock market, right? So if we get the crash that we're betting on, then that will undermine the oil trade temporarily too. At least, and gold too. Gold and oil will probably come down together at that point. And really depending on if we get a crash or if we just get a slow downturn and a slow emerging bear market. You know what I mean? So because in a crash people panic and there's all sorts of things happen in liquidity in terms of liquidity that are not all that rational. So like for in 2020 when oil went to almost zero, right? I mean that was so irrational, it was crazy, but it was rational. It was rational for that moment. It made sense at that moment. But if you zoom out, you relax, you see that these things that these things can be irrational, but they happen. So we get a stock crash. It could undermine the oil trade, bring gold, silver down, but then of course when you get a stock crash, what happens. The establishment panics too. So when they panic, what do? Is they start lowering interest rates and printing money again, right? Which they haven't done. I know that people think that they've been reflating a little bit in the last couple of years, but a little bit is the operative word. It's not, it's hardly anything. They haven't really undergone a new emergency easy money policy. They've only just been tapering interest rates from their highs, right? But they've been finding out that that's not as easy of a task as they probably think.
So you mentioned the stock market crash. Any predictions on when that might happen?
Geez, I mean, I've been wrong so many times on that. So I almost feel worthless for me to even respond to that. I don't know, Jeff, but it's due, and I'm still buying put option or call options on the inverse ETF, the inverse Nasdaq ETF, the 2 times leveraged one, QID. I'm still buying my call options on that. I think I could give you I can give you a technical case why the breakout to new highs here should be viewed with suspicion, but again, I'm on the wrong side of that trade. I'm offside, so I don't know how much value my input has. But from my experience, from the 30 or 40 years that I've been trading, and I've got all the tops, and then a couple. So, if there's been like what, how many, we've got the top in 2000, the top in 2008, we had the top in 2020, we had the sort of a top in 21, we got a correction in 2022 where our short strategy made some money. So, out of all those top, I mean, I've never missed any of the tops. And I think that, like you, I feel the same way that, it's like I feel like if we, if we throw in the towel here now, it'll probably crash the next day. So,
Yeah, that's how it usually works. And I've been through a few crashes in my lifetime, in my adult lifetime anyway, 2001, 2008. And I remember it was kind of similar in 2008. A lot of people were kind of like giving up on it, that it was going to crash. And just the fact that you're kind of like bashful on it right now, it actually makes me bullish that it's going to crash fairly soon because that's usually how it works, right? Usually the market will wring people out until like almost everyone just gives up. They're like it's just never going to crash, and that's usually when it happens, right? And with the state of the world today, who knows what could set it off? We're talking about World War III type stuff at the moment. The oil stuff could cause a massive, massive not only recession but even depression. We're even seeing Morgan Stanley's talking about oil could hit $500 in September if the war continues, right? If the Strait of Hormuz does not reopen. Obviously, any oil price probably over 200 probably causes pretty close to what you would call a depression. What do you think about that?
well, I think if the stock market doesn't crash, yeah, then the oil trade will continue to go higher. And another thing that I think everyone's overlooking is that bond yields are back up to U.S. government bond yields are back up to the 5% level. So they're back up to their highs for the century, and threatening to go higher. So if the stock market continues to go higher, those yields will go higher. The oil price will go higher. So these things won't get better for stocks. They won't improve. They're not things that are going to improve the fundamental argument for owning stocks. The valuation argument is, in my opinion, just blown wide open. It's an expensive market. For most sectors, the fundamentals are not good. Like you say, there's the minefield. The field is full of mines. Geopolitical, macro, of all kinds. So you can get any day you can get a catalyst that reveals how that this market is too expensive. For example, they don't have the market doesn't have the Fed behind it anymore. It hasn't had the Fed behind it for at least a year. It hasn't from my point of view since 2022. But the Fed has sort of been the Fed has been in 2023 and 2024. It was promising lower interest rates. It stopped doing that now. So the market doesn't have the Fed behind it anymore, in any way, shape, or form that way. So it's on the clock is ticking. There's only one sector that's really producing the earnings gains. That sector is dominated the averages. That sector is more expensive than the rest of the market, which is already expensive. And there's one more thing I will add that is that we kind of almost hinted at right off the bat, was given that we haven't had any major crashes since 2008. What is that? How many years is that? It's almost 20 years, right? What percent, over that period, what percentage of investors would you say are new to investing after 2008?
No idea.
Well, if you're gonna, if you had a gun to your head and you had to pick a number,
What
what?
percentage are new in the last 20 years? Well, it'd probably have to be a pretty big amount, right?
Yeah.
So yeah, I think most, like anyone under 50 or 40 for sure, because most people don't really get into these things until like their 30s and stuff, right? With like stock market and stuff like that. So people that are even like in their 40s have never seen a stock market crash really in their
Right,
adult lifetime.
right, right. And they've been conditioned, and they've been conditioned through punishment. I mean, we've been punished for being bearish, right? And so have others, right? And so a lot of today's investors may have been bears in the past and have capitulated and just, are passively long now, and are not, and a lot of them will argue, well, Jeff, Ed, we've seen 25% corrections. And every time that happens, all the Fed does is print again. It stops the correction and the market goes higher. So what happens? I sell my stocks. I'm out of the market. Unless I time it perfectly and capture that 20% decline and capture the bottom of that decline, unless I do that perfectly, then the capital gains taxes won't make it worth it. Right? So so what I'm getting at is the psychology component of this bull market. The longer a bull market lasts, the more the more committed investors are to it psychologically, and it's hard for them to imagine a bear market. But I mentioned demographics earlier on, and I think it's really important because the demographics haven't come into play yet, but they will. And those demographics are the fact that boomers are retiring now. If you remember in the 90s, the big argument in the 90s for why stocks should go higher was that the boomers, then turning 30-ish, I believe, started to save and invest. As you were mentioning, people don't start to get into saving and investing until their 30s or so, right? Well, that's in the 90s. That's what happened. That's when the boomers became savers and investors. So a lot of analysts were like, "Well, the market's going to go higher because of the demographics. The boomers are coming into the market now, and they're plowing their savings in, right?" So, but now we've got the boomers in retirement age, right? So for the most part, I think they're complacent. They're going into their, if they definitely have stocks exposure, and they may be complacent about because the market keeps making new highs, and we've only had 20% corrections, so they may be slow to get out. But I think once a bear market does grab hold, it's going to make them sweat about their retirement because the value of their portfolio will keep falling, and their estimates for what their needs are going to keep rising. So at some point, and probably if if irony and if history is any guide, they'll probably sell the bottom of the bear market, and they'll be the ones capitulating. After the Dow is down 50 or 60% over a couple of years, they'll be like, okay, well now I can't take it anymore. I'm gonna have to sell, right? And so I see that playing into the bear market that's coming too as well. So the psychology, the demographics, the macro environment, the geopolitical environment, these things are all negatives, and they're all overhanging a very, very expensive stock market that's full of very complacent, inexperienced. I can't say inexperienced, but maybe, as far as the idea goes, whether they've experienced a bear market before in their lives.
Yeah, it's very interesting. The longer something keeps going up, the more that people believe it's never gonna come down. And I'm actually I'm kind of the opposite. The longer something goes up and it hasn't come down, I'm more likely to think it's going to come down. But we don't have a lot of time left. I wanted to ask you about crypto. Bitcoin. I want to talk to you about Bitcoin and Monero. Bitcoin hit a all-time high in I think September of last year, about 126,000. It's gone all the way down to into the 60,000s. It's currently around 80,000. What's your take on where that's at?
A lot of people are under the assumption that we're in a crypto bear market, And I still think that that's questionable. If you look at the long-term trend line, that I've drawn in, based on that, it, I think that the Bears are just going with a very established 4-year cycle. So they see the decline as part of the fourth year of a cycle, and that usually is a bear market year. But a bear market in crypto and a bear market in stocks, they're different animals. First of all, the crypto bear markets are shorter, but they're more violent and steep. Um, but at the same time, this market has matured a lot, and I'm not so convinced that we're in a bear market. I think we've just seen a very steep correction, and I'm not also not and I also think that the nature of the structural nature of the market has evolved. So given that it's got a lot of institutional support now, a lot of institutional demand and interest. It's the original high risk tolerant investor has been replaced by the less risk averse but bigger money investor. And so the structure of the market has undergone a change over the last couple of years. And I, I'm shy about buying it after it's rallied $20,000, but I have not been shy in telling people to buy the dip at in the low 60s. I don't know if you remember my comments on that in the VIC and elsewhere, but I've not been shy in buying the steep decline, um, and so I'm not expecting it to go to 40 or 50,000 like a lot of bears. I think that we are working out a bottom right now. It might still come back a little bit, but I think we're working out a bottom of sorts. And I think that for the most part, if you ask me to explain the correction, aside from what I've just said, I would say that a lot of people FOMO'd into the precious metals over the fourth quarter of last year. So, that, probably left the crypto market for dead a little bit, with silver doing what it was doing. Gold and silver are traditionally not that exciting, but when silver was doing what it was doing, it was, it did excite a lot of crypto investors. We saw that firsthand, I think. Um, so I'm a buyer of Bitcoin here and of Monero, especially, right? It's come down quite a bit, or I think when from a high of $800 down to, I think it hit a low of 200. It's 400 now, but it hit a low of 240 or something. So I think that correction is done. That's a done deal, right? So it's just a matter of positioning yourself properly for the next move in Monero and Bitcoin, I believe. And I think also Bitcoin is getting a lot of bad press from inside the crypto area. There's a lot of division these days about whether it's doing what it should be doing, whether the developers are doing what the developers should be doing or not. Um,
Yeah, the chart of Monero actually looks pretty good to me, especially considering it's basically been delisted and banned from every major exchange almost on Earth. One exception is Kraken in the US, still has it. But almost every other exchange on Earth is like delisted, and it's actually looking pretty good. When you look at the long-term chart of it, it did have that high earlier this year, near over 700. It did drop down to around 300. It's currently back above 400 again, though.
Yeah, I agree. I think given that it doesn't trade on I think obviously if it trades on the exchanges, it would do better. But given that it's not listed on most on many exchanges, a lot of exchanges. I think that's kept a lot of the weak hands out. I think that market has a very strong foundational structure of long-term holders.
Yeah, absolutely.
I'm excited
it's one
about
of the
that.
only, yeah, it's one of the only cryptos really that is safe out there because everything else is so trackable in this world of government tracking and Palantir and all that sort of things. And in my opinion, it's one of the only real cryptos at this point, just because of the way the world is. And it's also insane that you have a money that every single person can see every single transaction you ever make. Like, that's just crazy to me. But yeah, Monero looking pretty good. So I guess we'll see what happens with the stock market. I have a feeling that you were so bashful about, picking when the stock market might crash, that it might happen fairly soon, because that's, just the way it goes usually, right? Like you said, I'm actually the same way. I've got some stock market shorts right now, and they haven't been doing well the last few weeks. And I was like, but if I sell, I know it's going to go down. I just that's how it always works that way. But who knows? Maybe it can last a little while longer here.
Yeah, I mean, that could be like a little bit of that gambler's fallacy, where we get like you toss a coin and it's like heads comes up 10 times in a row and you think next one's got to be tails, but it's 50-50 every throw, right? So
yeah,
could be a little bit
interesting
of that,
times.
right?
So yeah, definitely subscribe to our newsletter, dollarvigilante.com. We'll give it to you for free right now. Free. dollarvigilante.com/free trial. You can get into it for a couple of weeks and see what we're doing. We'll have our next dispatch coming out, issue. The May issue will be coming out on May 15th. You'll get that live as part of your free trial. Definitely interesting times. I expect it's going to be so many things happening this year. How about you?
Oh, geez, there's so many things. It's overwhelming already. It really is.
Yeah.
It really is.
Great. Well, thank you for coming on, Ed. And just go to dollarvigilante.com, dollarvigilante.com/free trial if you want to check out the newsletter. We're also on X at, I think it's just Dollar Vigilante. Somehow we're not banned on there. I don't know how that's happened.
Well, I think that platform has gone downhill so much. They probably don't care about it anymore.
All right, we'll leave it there. Thanks, Ed.
Yeah, you bet, Jeff.
Join us for a groundbreaking virtual experience on May 16th and 17th, 2026, inspired by the recent chaos in Puerto Vallarta that shattered the illusion of safety, even in paradise, and reminded us how fragile modern systems truly are. Many have forgotten that true security comes from self-reliance, and the point of this event is to rediscover that. This isn't about fear-mongering or doomsday predictions. It's about mastering practical tools for survival as essential strategies to unlock personal sovereignty and resilience. Learn from experts in food production, off-grid systems, crisis preparedness, personal defense, community building, and alternative living who are already building lives of true independence by preparing for when systems fail. Gain survival skills that could save your life or community in an unpredictable world. Visit anarchapulco.com now.